Hey, what's happening, guys? Dan Darrow here from Options in Play. So today I'm going to discuss weekly options. All right. Um, if you're like me and you have a love-hate relationship with them, which I'll be honest is really the best way I can describe it, um, then I sympathize with you. Okay. And I am going to kind of go over a little bit why I have that love-hate relationship with these weekly contracts. Also, I'll talk about when I trade weeklies, why I trade them in those instances, and also why I'll avoid them. Okay. All right. So let's jump into things here. So just a quick little breakdown of a weekly contract, just if you're not familiar with them. Um, it it really has come about mostly due to the popularity of options trading. Okay, because when options were first introduced way back in the 80s, 70s, 80s, these weren't around. All right. So as options trading has become more popular, more volume, I feel like the exchanges that started offering these, we're looking for ways to kind of meet the demand. All right. And originally, so like I said, originally like they were only offered in monthly increments, where some contracts actually are still only offered in monthly increments, and then sometimes yearly increments. So what they call leaps, right? So you'll see maybe on some names contracts listed for like January of this coming year, and also the following January, so of like 2021. So monthly and then leaps. But then in 2005 the CBOE actually first introduced these weekly, aka 1 week expiration options. All right, so that's what the weekly means is that they typically are open for trading like the Thursday or Friday prior to when they expire. So they're only really open for like that 1 week stretch. All right. But even though they first introduced these in 2005, they didn't actually really start to become more widely traded on different stocks and ETFs until 2010. So like the summer of 2010, that's really when they started to expand the program to include all sorts of different ETFs, and then they got into stocks, and then really it just kind of blew up from there. All right. So as as the interest for options trading grew, and as like the demand for these weekly contracts grew, it's really kind of been like an area that most traders have kind of gravitated towards. All right. And just because these weekly contracts do a ton of volume, it really doesn't mean that they're always the best options to target, right? So they're not always the best ways to go about building a strategy for whether it's a swing trade or a catalyst trade or what have you. All right. So most beginners, and even people that aren't beginners, really, tend to gravitate to these weekly options because of the low cost of the contracts, right? The lower debit. Um, but in reality, like these contracts are actually some of the trade toughest to trade consistently. So yes, like the premiums are oftentimes a lot lower, or they can be a lot lower. But the difficulty in like timing these contracts and the difficulty in trading these contracts consistently, to me, seems to be much higher. And the reason for that is because these weekly expiration contracts, right? They're going to have higher implied volatility. Okay, and they're going to have a higher theta versus longer term contracts. So that means that you're constantly battling time. And for maybe the people that aren't familiar, theta is the option Greek that measures the rate of time value erosion. All right, so that's basically tells you what that contract is going to lose in time value per day. All right, that's what theta means. So with the backdrop of you constantly battling time and higher implied volatilities, it just makes the margin for error on these contracts that much lower, right? So, for instance, if you're holding something and there's a reversal during the day, I mean, like the hit to the premium is going to be more severe just because the implied volatility is higher and the theta is higher, right? Also sideways. So if we end up getting into like a consolidation, or if the position you're in begins to consolidate, that theta, that rate of burn, is going to be the highest on those short-term contracts. So sideways action is going to be, particularly hard on these lower lower expiration, shorter term contracts, the weeklies. All right. So let's hop into a thing. I'll kind of go over what I mean here. So Amazon, okay. So just using like a little bit of an example here, right? Um, you can see. So these are the weekly contracts for this week. So this is like the closest to expiration contracts, the weekly expiration, all right? And you can see, just very quickly, right? You can see the 1785 call, right? The theta is going to be negative 2.65, and the implied volatility is going to be a little bit above 28, right? Now let's compare that to the following week, all right? You can see the theta of that same contract, the 1785 for the next week, so 1 week extra, is going to be negative 1.45, and the implied volatility is going to be 26.78, 26.8, right? So both the theta and the implied volatility are going to be lower. Typically, like the further out you go, there'll be instances where that's not necessarily the case, but just for explanation purposes here, you can see what I mean. That the theta, so that means that means that each day until expiration, this contract will lose $2.65 of value, just in time value until expiration on September 6th. That's when they expire. Versus the September 13 contracts, the 1785s, will lose $1.45 of value, right, of time value, into expiration the following Friday. So 2 Fridays out. So you can see what I mean by that. All right. Let's go back here. Okay. Hopping back into things. So some tips for trading these weekly contracts, right? So I kind of went over like why they're tough, but they actually really can be useful in certain circumstances, right? So it's not a complete avoid for me. I mean, there are times when I'll trade them, and there are some they do provide utility in certain circumstances. So day trades, right? If you're planning on only opening the position after the opening bell, and closing it prior to the bell that same day, so within like the 1 day time frame, then the weekly contracts can actually be maybe some of like the better ones to target. Or if you're only planning on holding it for potentially 1 day, so maybe from 1 day into the next, open it 1 day, hold overnight, and close the next day. So just very, very short holding period. I mean, that's the key here. Very, very short holding period. And the reason for that, I find, is that the visibility tends to be higher. Okay, so your trade idea, you might have a strong opinion of like an hour, maybe it's like a 30-minute chart, hour chart, maybe 2 hour chart. Maybe it's just like closes strong 1 day and you're looking for a strong open the next day, right? So very short term holding period. Also, in these instances, right, it may not be necessary to pay for the extra time because you're only really planning on holding it, for that very short window, right? If you're only planning on day trading it, or if you're only planning on holding it just maybe overnight, then the extra time might not be necessary for you. Trades 1 to 2 days. So basically, things greater than like an overnight or 1 day hold, I feel you're better off going to longer term contracts, and really, even if that's only like one additional week, just because the wider window will give you just a kind of like a better shot on goal, right? So it'll give more time for that trade to develop. Also, lower implied volatility, and lower theta too, right? So let's go back. We'll use Amazon as an example again. Um, So kind of what I mean by that is, so say for instance you had an Amazon straddle coming into the session, right? But you can see here is that Even though like the stock has moved, about $10, actually a little bit more than 10 points, right? What you can see is that the straddle is actually lost value, right? So this is the weekly straddle. So you can see that the calls have gained about 345, whereas the puts have lost about 715. So net that straddle would be down, right? But if you'd come in, so But if you had come in and just looked to day trade those same, say for instance the 1785 calls, right? Like the low of the day was about 1130, um, like $11.30, whereas like the high of the day was 27.80. So that contract had a wide trading range during the session. So if you'd come in flat, there was potential even to possibly capitalize on a move had you wanted to day trade it, right? Because like the contract had a pretty significant move in the price, all right. Whereas going out through next week, the 1785, right? So the low of the session was about 23.50. The high was 40. So what you can see is that those contracts. I mean, not only do they cost more in premium because you got to pay for time value, but like the dollar trading range from a percent point of view actually wasn't as significant, right? Where the previous was about 11 to say 27. This is only 23 and a half to 40. So percent wise, it's not that big of a swing, right? So if you're only thinking about day trading these contracts, then the shorter term names, the weeklies, right? They could have, they could provide more of like a percentage movement. If you come in flat, you open it after the close and then you close before the bell, right? So that's kind of what I mean on that front. All right, back to the lesson again here. So, kind of walking through that Amazon, you'll see what I mean. You kind of see what I mean by like the day trading aspect, and then there's actually another utility that I like to look at, which is like the earnings event um, strategy. Okay, so weekly options I find can also be useful if you're looking to target like a major news event, a major catalyst, earnings, for instance, right? And the reason for this is that um, you have a reasonably good idea that the stock is going to move in a very short period of time, right? So like the just like the nature of the weekly contracts, it's all designed around like very quick movement because you need to do very quick because you're battling time, like I said in like one of those first couple slides, right? So for the weekly expiration contracts, it's very very important to like either be targeting a big move quickly or know that a big move could potentially happen quickly, and earnings, other major news events are significant catalysts, and they tend to move stock prices pretty dramatically, pretty quickly, right? So in the case of earnings, um, you could look at potentially like these weeklies, right? Because you know that there's a pretty good chance that the stock is going to respond to like those numbers and have a pretty sharp movement in that like the 4 or 5 day stretch. But what I also find is that just due to like the pricing of like the contracts and how so much of premium and like short-term stuff is built into the implied volatility of options around these events, going out one extra week, it typically only requires like marginally more premium, and it gives like a wider window for the trade to develop. All right. So again, let's go back and I'll show you what I mean here. So for instance, Lulu. So this company is going to be is going to be turning in earnings this week. All right. What you can see is that the implied volatility of the options very high, right? About a 140 implied volatility for the calls and the puts, right? You can see right here about 960, 965 for the 177.50 call and about 850 for the 177.50 put, right? So like the straddle is pricing in just about 18 points for this week. Okay, now what I mean when that's the second part of that previous slide about like going out one extra week, you might be only paying marginally more. Because so much of like the near-term contracts, the premium is built into that catalyst. You're not actually paying that much extra for time value. So the same straddle, right, for one extra week. So just using the midpoint, so like the price didn't move, is only about 19, right? About say about 10, a little over 10, and a little under 9, so 19. So you have the weekly expiration that will expire only in a couple days, which is looking for about 18, right? The 177.50 straddle, and you get 5 extra days really for only about $1 extra, right? Because next week's 177.50 expiration is only about 19. So 18 for this week and 19 for the following week, but you have 5 extra trading sessions. So that's why I said sometimes you really need to you really need to like weigh the cost benefit of like the short term weekly options versus the longer dated contracts, because there may not, I mean, it's not the same in every instance. Some things will be different, but in certain scenarios, there may not be that much of a difference between the pricing between this week, so the weekly, and next week. So, even if your holding period's very short for like these earnings catalysts, right? That extra week might give like a little bit of a wider window for the trade to develop, just in case maybe it doesn't move immediately. All right. So, just to summarize here, we have there's weekly contracts are great. They have a ton of volume. Premiums are lower, and they have utility when you're looking at possibly like shorter holding periods. But the thing to remember is that they may not be appropriate for traders just starting out, just because of that real aggressive nature of the pricing, right? So, if you're just beginning trading options, maybe it's best to kind of like avoid like the real short-term weekly contracts until you have a little bit of like a base, right? Some little bit more experience, just because that constant battle of theta and implied volatility for like those short-term contracts can be really tough for people beginning out. Also, weekly contracts can be useful for earnings and events because the stock is going to move quickly, right? And that's really important with these short-term contracts, is either the expectation that it's going to move very quickly, or like a reasonable suspicion that it could move very quickly, and earnings or whatever catalyst is coming up that week is as good of a reason as any for a stock to have a pretty significant move in a short period. All right. But just to kind of drive the point home, you still want to weigh like the cost benefit of the weeklies versus possibly going out a little bit longer, especially around catalysts, because sometimes so much of the premium is built into that catalyst that there's not a lot of time value going out just a little bit more. So again, the cost benefit of the weeklies versus just slightly more time, like one extra week, can really be kind of favor like the slightly longer term. All right. So if you guys like what you hear, please reach out, or like the video, or follow up. You definitely know how to get in touch with me, right? Please be on the lookout for more options and play videos on YouTube, on Facebook. I am looking forward to a pretty busy stretch here. I mean, September is a great time for volatility. Typically, we're in a pretty historic stretch right now with some extended action. So, looking forward to some good action over like the next few weeks, few months. So, yeah, plenty to do, right? So, have a wonderful night, and I'll talk to you guys all soon.